The dollar's once unshakable dominance over global markets is starting to show cracks. And surprisingly, the pressure isn't coming from the usual suspects, China or Russia. It's coming from Australia, one of America's oldest allies. Known for its massive mining industry and long-term partnership with the US, Australia is quietly realigning its economic ties toward Beijing. While Washington struggles to maintain control through tariffs and sanctions, China has been methodically constructing a new trade ecosystem, locking in agreements and strengthening influence one deal at a time. The most significant change is unfolding in the iron ore market, a sector that moves hundreds of millions of tons a month, where China now dictates nearly 3/4 of global demand. What was once simple commerce has transformed into a strategic lever of power. Beijing understands that each shipment leaving port can shift prices, redefine contracts, and bring the world closer to a currency system less dependent on the dollar. China's appetite for iron ore is unlike anything the world has ever seen. Monthly consumption by Chinese steel mills and factories exceeds 100 million tons, representing about 75% of all global imports, an amount no other nation even approaches. This dominance gives China enormous leverage. A reduction in purchases can trigger a market collapse overnight, while an increase can send prices soaring and delight producers worldwide. Such influence extends far beyond commodities. It can sway entire economies. Countries like Australia and Brazil rely heavily on this trade, with their national budgets, employment rates, and export revenues tied directly to Chinese demand, a fact Beijing is fully aware of. When one buyer controls the majority of a market, it effectively writes the rules. Historically, the United States exercised similar power through the dollar, forcing nations to adhere to its financial system or face economic isolation. China is now employing a comparable strategy, but through trade. Iron ore has become a proving ground for a larger vision, gradually moving global commerce to yuan-based settlements. By promoting transactions in its own currency, China converts ordinary trade into strategic leverage. Each shipment paid in yuan reduces reliance on dollars, increases the global circulation of China's currency, and strengthens its international standing. This isn't coercion, it's influence earned through demand. Suppliers who wish to maintain business with China must adapt to its financial language. For Australia, this shift is uncomfortable yet unavoidable. Iron ore is the backbone of the country's export economy, and nearly all of it goes to China. Losing access to that market would be catastrophic. So when Beijing indicates a preference for yuan payments, companies pay attention. What began as a subtle experiment has evolved into a turning point, a first step toward currency diversification within one of the world's largest commodity sectors. For China, it's just the beginning of a broader strategy to anchor global trade to its own currency, one contract at a time. The new deal between China and Australia is historic. BHP Billiton, Australia's largest company and a leading global iron ore supplier, has agreed to process 30% of its sales to China in yuan. The agreement, valued at roughly $10 billion, covers close to 90 million tons of ore, enough to meet China's steel industry demand for an entire month. Until now, payments were conducted in US dollars, but now the yuan will flow directly, bypassing the dollar entirely. For China, this is a strategic masterstroke. Locking in critical resources in its own currency reduces exchange rate risk and bolsters the yuan's global influence. Each ton paid in yuan diminishes dependence on dollar reserves and proves that international trade can operate independently of the American financial network. For Australia, the decision is pragmatic and symbolic. China is its largest customer, taking the majority of exports. When a client of such scale requests payment in its own currency, refusal is not an option. With BHP on board, other companies are likely to follow. The iron ore market is immense, and even partial adoption of yuan payments can pave the way for other commodities, such as copper, lithium, and liquefied natural gas. China's strategy is subtle but effective. It doesn't impose change, it makes it advantageous. Stable rates and efficient transactions make yuan settlements appealing. The revenue Australia earns in yuan will likely return to China through investments, creating a self-reinforcing economic cycle and further sidelining the dollar. The closer China draws Australia into its economic orbit, the stronger the momentum toward de-dollarization becomes. What seems like a routine trade deal is, in reality, a financial experiment with global repercussions. China is distributing its own chips, currency that holds value within its growing system. The more countries participate, the more the center of global trade shifts eastward. China's influence over Australia continues to deepen. Through financial arrangements, Fortescue Metals Group, one of the world's largest iron ore producers, has secured a 14 billion yuan loan, roughly $2 billion, reinforcing Beijing's leverage and further embedding its sway in global resource markets. China's two largest state-owned banks, the Industrial and Commercial Bank of China and the Bank of China, have arranged a deal that is sending shockwaves across the financial world. The terms are almost unheard of: no collateral, no strings attached, and an annual interest rate of just 3.8%. To put that into perspective, if Fortescue had borrowed the same amount in US dollars, the cost would have been at least 5 to 6%, because US loans are tied to Treasury yields, which were hovering around 4% in August. That difference may sound minor, but in real numbers, it adds up to tens of millions of dollars in savings every year. China is intentionally making financing cheaper, faster, and more accessible. It is offering what the dollar no longer can: stability, low cost, and reliability. The funds are earmarked for green energy development, a sector that is becoming increasingly critical for Australia's transition toward clean technologies. But there's more to it than meets the eye. While it seems like Australia is merely getting a cheaper loan, Beijing is quietly implementing a long-term strategy. China isn't just lending money, it's shaping an entire industrial ecosystem. Every yuan-denominated loan strengthens dependence on Chinese banks, slowly internationalizes the yuan, and creates opportunities for Chinese companies to dominate foreign markets. This isn't financial competition, it's financial strategy. For Australia, the immediate benefits are clear. The money will fund cutting-edge renewable energy projects, helping the country transition away from fossil fuels at a fraction of the cost it would face if borrowing in dollars. But for China, this is about more than helping a trading partner. It's about securing markets for Chinese technology, machinery, and expertise. Beijing is not only financing Australia's green energy revolution, it's ensuring that China will be at the center of it for decades to come. While Washington remains mired in fossil fuel politics, dismisses renewable energy as a passing fad, and debates tariffs, Beijing is quietly building the industrial infrastructure of the future. Even before receiving the $14 billion UN-backed loan, Fortescue Metals had already signed a $400 million deal with Chinese manufacturer XCMG for zero-emission mining equipment. These aren't ordinary machines. They are electric dump trucks, loaders, and cranes, built entirely with Chinese components, batteries, and software. Each piece replaces equipment that was previously sourced from American or European companies. By linking loans to technology exports, China is essentially financing Australia's green energy transition at its own expense. This is strategic finance at its finest, a win-win for Australia in the short term, and for Beijing's long-term global influence. The UN loan also ensures that future contracts, spare parts, maintenance, and upgrades remain within the Chinese industrial ecosystem. It's a self-sustaining, closed-loop system. Chinese banks provide the capital, Chinese companies supply the equipment, and ongoing demand keeps the system alive. For Australia, this is a fast and cost-effective path to modernization. For Beijing, it is a masterclass in creating long-term dependency, not through pressure or threats, but through opportunity and cooperation. Meanwhile, in the United States, the story is very different. Policymakers are still debating tariffs and clinging to fossil fuels, while high interest rates and reluctance to embrace green energy leave the field wide open for China. Chinese companies are already mass-producing machinery for a new industrial era, machines that are affordable, scalable, and built to last. Every loan paid in yuan strengthens Chinese exports and weakens the dollar. Every new shipment of Chinese equipment at a foreign mine subtly chips away at America's historical dominance. The global economy is gradually shifting. Countries are starting to operate in a system where the dollar is no longer the central pillar. The era of unchallenged American financial supremacy is ending faster than anyone predicted. Even longtime US allies are beginning to transact in yuan. If this trend continues, the question is not whether the dollar will lose its dominance, but when. This is a quiet revolution in global finance. China is not engaging in trade wars or threatening sanctions. It's building influence the old-fashioned way, with credit, infrastructure, and industrial strategy. It's turning loans into leverage, technology into long-term partnerships, and finance into a tool for global influence. In this new world, power doesn't come from speeches or tariffs. It comes from who controls the money, the machinery, and the markets. For Australia, this may feel like a golden opportunity, a chance to modernize its industries, develop green energy, and save billions. But it also means long-term dependence on China's industrial ecosystem. Every contract signed, every machine imported, every yuan-based loan reinforces Beijing's presence and influence. For China, this is about shaping the 21st century industrial landscape, one loan, one machine, and one partnership at a time. The question now is, how long before the dollar truly loses its crown? How long before even its closest allies start moving away from it, transacting in yuan instead? The rules of the global economy are changing quietly, but rapidly. And if you think this is just about money, think again. This is about the future of energy, technology, industry, and power. So what do you think? Are we witnessing the rise of the yuan as a global powerhouse powerhouse? Will the dollar remain king, or is its reign quietly slipping away? Share your thoughts in the comments. Hit like if you learned something new, and don't forget to subscribe. In the next video, we'll dig deeper into China's strategy and reveal how it's quietly reshaping the global economy, one country at a time.